Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now today we're discussing a very important question that's on every retiree's mind. Where should I invest my retirement corpus? Suppose you have 1 crore rupees and you want to generate income and preserve the capital as well. So how should you go about it? And to discuss that and more, we have with us our in-house expert, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So to begin with, how should one decide how to invest that 1 crore retirement corpus?
This is the most important question. There is not a single day when we don't get a mail that I'm planning to have this much and will it be good enough for my this much requirement.
Right.
So it is everybody's need. Everybody is aware that he will retire. He will need supplementary income, or that will be his primary source of income, his investments or his accumulation all his life. The unfortunate thing is that if you plan it as you get closer to the retirement, most of the work has to be done in the previous 20-30 years.
Right.
The steps to this is very straightforward. One is that to understand the basic need, what do you need? What is the goal of such an investment? You have to invest in such a manner that you are able to derive a return from your investments in a manner that it is unlikely to go down in value dramatically in a brief period of time. So it should be, conservatively structured. Second is that it should generate enough return that you take a good part of it, but you are still able to leave a part of it for it to appreciate. Otherwise, it will not be able to support higher income needs thereafter. Your goal is not to just preserve the capital. Your goal is to grow the capital so that it can generate higher income in future. So income and growth both is as important. If you just consume all the income, then you will be deprived of the growth. And in future when you need more money, because of inflation, you will not have it. If you just grow it, if you are focused entirely on growth, then in a bad market, it will tank and it will unnerve you and you will be disappointed. So you have to find this great balance. And for that, you need to really work on an asset allocation. One is you need to work, as I was saying, that you need to work for 10 years, 20 years, 25 years, 30 years before that. It is very important for you to have a margin of safety. Because if you build 1 crore and if you're consuming 7%, your need is 7% of that, then any bad market or a prolonged bad market can actually put you in trouble. Have so much capital so that 4% is good enough in the initial years, and thereafter maybe 5%, maybe 6%, or a growing corpus or growing value of your investment can support that. So it's very straightforward. Invest your money something like half into equity, half into debt, or 60-70% into equity, 20-30% into debt.
So now let's break it down point by point. It's fine, don't withdraw too much too soon. Let some part of the corpus grow and decide on the income that you need and set a withdrawal rate for yourself that is conservative. That's the first step. Going from there, the next step is asset allocation. What are some of the safest options to generate income in retirement?
One is that, you should have a ladder of things. You should have some set of, you have to invest in fixed income. And if I'm saying half into equity, half into debt, and you can take into account the senior citizen savings scheme as well as part of your fixed income allocation, post office MIP as well. And that way you can deploy 30% of that, of your 1 crore into those investments. You will get predictable return. It will be absolutely safe. And the remaining money, invest in such a manner that, your overall 1 crore, 50 lakh rupee goes into equity. Post office MIS and senior citizen savings scheme is the safest thing. You are lending your money to Government of India. So there can't be anything safer than that. Besides that, they are also high yielding. And even government has enabled senior citizen savings scheme because it is targeted to senior citizens. Even post office MIP is yielding very decent return. So a good part can get into ultra safe, high yielding. And if this is your only source of income, it will also be tax exempt because now up to 12 lakh rupees of annual income is tax sheltered. So I think, senior citizens are a big beneficiary of the tax break we got this year.
Okay. Now, the base level of income, that's decided, but 1 crore is a huge corpus, assuming that, that's the corpus that you've got your retirement on. So after maxing out senior citizen savings scheme and post office monthly income scheme, how should one go about allocating the rest of it to debt and equity? What should be the allocation like?
One is that have the full picture, have the big picture, that half of your money should be in fixed income, half of it will be in equity. Don't complicate it, keep it very simple. Rebalance it annually and revise your withdrawal rate. Do all the calculation on how much money you will be getting from senior citizen savings scheme. That there you get every quarter. Post office MIP, you get it monthly. See how much money you are getting every quarter. The remaining money you should derive it from the post office, from the short-term debt fund. And after a year, see that what is the remaining value of equity and what is the remaining value of debt. Rebalance it again. And then on the revised value, mount that, 6% withdrawal rate. That way, if the value has gone up, you will be able to revise it upward. If the value has gone up very, nicely and dramatically, then you can revise it upward and, you can feel happy about it. If it goes down a little bit or if it is not going up well enough, make sure that you are not revising it. Because it's your capital. If you deplete your capital, you will run short of income.
Right. So that's a balanced approach. Yeah. Some guaranteed income investments, some in debt funds for flexibility, and some chunk in equity for growth. Now coming to SWP, the systematic withdrawal plan. If you could explain what is it and how can one, a retiree use it for capital preservation and income generation?
It's the converse of SIP. SIP is a mechanism of, providing small money, turning it into a large sum. SWP is the reverse of it. Instructing periodic small withdrawal from your investments. It is just a simple withdrawal plan. It is like, on 1 crore rupee, if you mount a SWP, make sure that your withdrawal rate is not more than 5% in the initial years. At most 6%, ideally 4%. And then revise it periodically. 3 years down the line, if your capital has grown, make it 4% of the the grown up capital. That way it will be able to support a higher income. So this is that simple, and do it with systematic withdrawal plan. Systematic withdrawal plan also gives you a mechanism of, do it annually so that you are able to revise it in the initial years. Make sure that you are not eating your capital ever in the initial few years. Let it, grow as well besides your withdrawal. And systematic withdrawal plan enables you a mechanism that you can get work on a desired level of, predictable income coming to you at a defined periodicity. Besides that, it's completely tax sheltered because a good part of your income or good part of your withdrawal will be capital itself. The appreciation component will be very low. So on a 1 crore rupee or even on a 3 crore rupee, if you are actually taking out 6% of 3 crore rupees, which is 1.5 lakh rupees, there will be no tax incidence on this because the gain component on this for the first couple of years, there won't be any. And you are able to save on taxes, convenience, flexibility. So it's a great way of, having a methodical plan to support with it, to derive income support.
Yeah, so basically turning your investments to a regular paycheck, that's tax advantage is taken care of and flexible also. Now, should one also consider annuity plans in India while planning for, a fixed amount in retirement? Are annuities a viable option?
Annuity is a very desirable product, but in India it has not really taken shape in a manner which is good for us. One is that we only have those fixed, the annuity coming in three format, return of capital, not return of capital, and supporting it, income support for the successes of your investments. That's one. The return on these are so low, and the longevity has gone up. So effectively, annuity has become a very unfavorable. I would say that if you are looking for income from your investment, annuity may not be a very desirable vehicle. It may not, because and more so for a person who has experienced equity all his life in accumulating it. If you can withstand this little bit of ups and downs, little less predictable, but you can actually think, because the price of guaranteed return for all your life actually lowers your return. And that lowering of return is something which most people may not be able to reconcile with. For NPS, it is mandatory to have 40% of your accumulation turn into annuity. And even there, I would urge people to defer. You don't have to necessarily go for annuity on your retirement. You can avoid it, postpone it till you turn 75. And for the remaining 60% of your money after your retirement, you can mount a withdrawal plan.
Right.
So your money is actually prevented from getting into annuity. And I would think that, growing your money well and not locking into a guaranteed income, which is relatively lower, and no other recourse to that may not be a very desirable option. Avoid it as far as possible.
Right. So a self-managed plan can give a better inflation-adjusted return if it's wisely implemented.
More so if somebody has gotten used to it all his life in his accumulation, so it will not scare you. It is meant for really naive and gullible people who just don't want to take chance, invest that money and sleep over it. But the real problem is that most of the annuity return is on that fixed capital. The inflation-adjusted annuities hardly get you anything meaningful.
Right.
They might make you poorer.
Okay. So finally, if you had to list down 5 points, 5 takeaways that investors should take from this discussion, what would they be?
Prepare for your retirement long before your retirement. Be focused on asset allocation. Half of it in equity, half of it in debt, 2/3 of it in equity, 1/3 in debt. It's a very inverse connection. Greater the dependence, more conservative you should be to meet your goal. And that way you should be more tilted towards fixed income. Resist the temptation of taking your money out just because you have some impulsive need or some consumption which might be negotiable or which might be avoidable. Just be careful that this is money which is sacrosanct. You can't really take chances with that, and just be methodical about it and revise your withdrawal rate every 2-3 years. Initial years, just let it accumulate so that you get the time to revise it upwards.
All right, so balance and discipline are the keys there. Now moving on to the viewer's question. Parvata Vardhini asks, people want to generate a regular income when they retire or are no longer in active jobs. In such cases, taxation becomes a burden. While the government offers a rebate for income up to 12 lakhs, income from capital gains is capped at 1.2 lakh rupees, after which it will attract 12.5% tax. In such cases, IDCW becomes more attractive than SWP. So can you share your thoughts on this with a real-time example in this regard?
One is that, you have to see that, assume whatever you have accumulated and you are doing a systematic withdrawal plan. Because of the systematic withdrawal plan, a good part of your money will be coming by way of capital. There will be a cost of your investment. Only the gains are taxable. Now, given that your gains, if that gains, up to 1.25 lakh is exempt. After that, you also have that basic exemption. If this is your only source of income, and assuming that you need 1 lakh rupees every month, first you have to see that the 12 lakh rupees that you take out every year, how much of it is gain and how much of it is capital. You are not liable to pay taxes on your capital. Only the gains you are liable for, of which the first 1.25 lakh of capital gains is exempt from taxes. The remaining money, you will also be eligible for that basic exemption of 2.5 lakh rupees. So if you have this, then the remaining money, whatever be the capital gains, you are liable for taxes of 12.5%. So plan accordingly. You can't really, all your money that you take out by way of a systematic withdrawal plan is not subject to tax. This is the lowest possible tax from your, from your investment possible. Because if it was income, then it will be taxed at your marginal rate. If it was, in any other form, so this 12.5% return from equity, if it is structured like that, you can reduce your tax in a very efficient manner. Yes, you are liable for taxes even in your retirement. The IDCW plan may not be very desirable. One is that you don't know when the fund company will give dividend and when it won't. So that's the first problem. It may not fulfill the need to have a predictable income and a bankable income from your investment. Fund companies will give dividend amount and a time of your choice, their choice. Not yours. Besides that, there's absolutely there's no other benefit. And here you have mostly on a larger sum, deriving capital gains is always better than any other form, simply because it's the lowest possible tax rate.
Right. Well, thank you, Dhirendra.
Thank you.
So the goal is not to outlive your savings in your lifetime. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.
ये है मिस्टर सैनी और इन्हें है बड़ी बेचैनी। कुकिंग रील्स के बन गए फैन और बनाया खुद का कैफे खोलने का प्लान। जब साथ बने फ्राइड राइस, लॉलीपॉप तो कस्टमर बढ़ते गए नॉन स्टॉप। एक कैफे के हो गए 4, बढ़ता गया फैंस का प्यार। ऑटोग्राफ, सेल्फी, इंटरव्यूज, पर इतने में प्लानिंग का उड़ गया क्योंकि मिस्टर सैनी भूल गए उनका सबसे इंपॉर्टेंट प्लान यानी SIP। तो अपने ड्रीम लाइफ को सिर्फ डे ड्रीम मत बनाओ, उसे पूरा करने के लिए SIP स्टार्ट करो। एन इन्वेस्टर एजुकेशन इनिशिएटिव बाय आदित्य बिरला सन लाइफ म्यूचुअल फंड।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।